Hey, if you're just about to retire, or maybe you've been retired for a couple of years, heck, even if you've been retired for a long time, and you're at all worried right now here today about bubbles in the market or when that next market collapse, that next market downturn is going to occur, pay attention to today's episode because we're going to talk about what could happen to you if you don't get out in front of it and stress test your plan today. Hey guys, we're back. It's Rise in Retirement. My name is Jet and that is Taco. And we're talking today about all the risk that you're hearing in the markets, on the news. Where is this market heading? Are we heading for a downturn? When's the shoe going to drop? And we have a case example, hypothetical case example with Brian and Elaine, who are 67 and 65. They just retired. And they are pretty aggressive investors. $910,000 saved as they entered retirement, and they invested that money pretty aggressively throughout their working career, and they have retired and not changed a single thing as they have taken their first steps into this new retirement.
Heavy into the equity market. 80,
that's how they grew it.
85, 90% of the portfolio basically outside of that cash. They have 650,000 in IRAs. 160,000 in brokerage, 100,000 in cash. And so everything outside of that cash is in the market. In the equity market. They're 67 and 65, $8,000 gross per month income need. That's what they
living off of,
doing all the things they want to do. At this point, they've got $3,000 coming in from Social Security, $1,800 from a pension. So they have a monthly shortfall of $3,200, which is a 4.2% withdrawal rate. So they just recently retired. They've really seen their portfolio maximize in the last, 2, 3, 4 years.
Been good.
They used to be the individuals thinking we're going to have to work forever. Then all of a sudden, they get this huge return in their portfolio. They're seeing all this growth, and finally retirement looks more realistic.
It's like the stars have aligned.
I know. And now here they are with a 4.2% withdrawal rate, and no changes though. And so that's what we're going to talk about with the planning challenges.
Well, it feels good, right?
Feels great.
Last couple of years have felt great, especially if you've been invested in the equity markets in some fashion. I mean, if you have, you know what it feels like.
But now what you hear is the big, the buzzwords, right?
Well, let's talk about that for just a second. Like, what are you hearing out there right now? I mean, I'm hearing about AI bubbles. We had
how long can this thing sustain? PE ratios on stocks being too high. Everything's
valuation conversation. I mean, we had the government shutdown that threw some volatility into the markets, and that was more of a subtle one-off type of thing. But it's out there. Still battling in the inflation data. We're still battling employment data.
How long can this thing go?
It's been 3 years now. If the market ends positively this year, it's third straight year. So it's got to be on your mind. I know it's on a lot of our clients' minds and investors' minds right now.
So their number one challenge, and this is a challenge if things go south, is that they have too much exposure to market volatility on a pretty, call it, tight withdrawal rate. Not tight, the 4.2 is very, very good, but they don't have room for failure with it. If those stock market does tank, if they do see a bubble,
certainly
burst.
Based on their current allocation. We mentioned they were really aggressive.
Exactly.
How they're invested. So a little bit too much exposure, something that probably needs addressed, whether they've thought about it or not. Planning challenge number 2 goes hand in hand with that. And you started to talk about it. It's sequence of return risk. It's the worst case scenario for them. They've just entered retirement, and somewhat immediately within the next couple of months to the next year or two, they go through a major market downturn without adjusting their exposure, and it takes a huge bite out of their portfolio. And here's the only difference. While they're working, maybe it's not that big of a deal if that happens because they're adding money to their accounts during that period of time. But the difference that has occurred is now they're withdrawing money. We mentioned they have a shortfall. And so they have a negative sequence of return risk. and they're compounding that because they're taking a monthly distribution so that they can live and spend. So we got to be careful with that.
Yeah. Yep. And the last one's a mentality thing. And we like to refer to this as anchoring bias, which is when the markets do so well for so long, for example, you just kind of start expecting that. And that's kind of where they're at, is they just expect the same returns that they've been getting over the last decade that has really gotten them to where they're at now, that's just going to continue. This is how things work.
I'm cracking up because the best, most recent example of anchoring for me is like, I am just anchored to the Cleveland Browns just sucking all the time now. And so like, that's my expectation. And at some point, maybe it'll change, but it's like going to the casino too. You walk in with $1,000 and you're anchored to that $1,000,
Yep.
right? For some people, it's hard to walk out with $500 left in their pocket or 200. You got to get back to the 1,000 before you walk out of there.
Yep.
Strategies.
Yeah. So, I mean, I think the first one, you kind of alluded to this at the very beginning, is what they need most right now is to stress test their plan.
Well, so I mentioned that. How would you suggest that they do that?
I think they need to look at potential bubbles in the market in the past. For example, based on how they're currently allocated, what would have happened to your portfolio? Well, 2022 was not a great year in the market. What would your current setup have done during 2022? We can go to the COVID area, 2020 early on. Obviously, that was still a good year overall, but the 08, 09, the .com bubble burst, start stress testing against these different scenarios to see, hey, what do I stand to lose based on the allocation that I have?
I think if you do it that way, I like that. And that's something that we do for clients at WA Smith Financial, is we run them through a portfolio stress test, cost and risk analysis. I think the biggest thing that people get out of it is they see analytically how much I stand, or I could call it how much I have on the chopping block,
right?
Versus using words. One of the things I hate, the thing I see the most that I can't stand, is when you ask someone how aggressive they are or what their risk tolerance is, and they just read their statement where it says investment objective at the top.
Yep.
And it's, well, we're moderately conservative.
Yeah.
Those are words. What does that mean? How much money will you have on your next statement account balance if the market dropped 10% from last month to this month?
Yep.
Do you actually know?
Yep.
So
I think it's key for anybody. We always tell people, number one, don't get a second opinion from the person who gave you the first. Part of our, retirement tune-up, when we meet with somebody, they come in, they sit down with us. It's, hey, let's take a look at what your current situation looks like. Let's stress test this thing, and not. This is another crazy mental thing, right? Is talk dollars. Real dollars, not just percentages. It's wild to me sometimes where you talk to someone and you're going, hey, you have 20% on the chopping block here. If we were to see a 2022 type of market, you could potentially lose 20%. Oh, okay, that's not bad. Okay, so for Brian and Elaine here, that's 180 pushing 200,000, and then you say it in dollars.
$182,000.
And one spouse all of a sudden goes, that would devastate. I can't lose $180,000. No way.
Mm-hmm.
And so that is what a stress test will do, is truly identify what do you stand to potentially lose in a certain situation.
Here's another strategy that I like for them. And this is because they do have an income shortfall.
Yeah.
And they need to take a monthly distribution so they can live happy and do the things they want to do. Is I would really suggest that rather than have a $810,000, 100,000 of its cash, rather than having $810,000 of your money, your retirement portfolio, basically the bulk of it in the market, as aggressive as you have it, maybe we figure out what portion of that money needs to be invested a little differently, maybe a little bit more conservatively or a lot more conservatively, to create the $3,200 a month that you need, or a large portion of the $3,200. We'll call it segment your income out.
Yeah. So when you say that, and you kind of, we talk buckets, right? And kind of having purpose-based buckets, at a minimum, there's no perfect answer here,
Yeah.
but at a minimum, what do you think an individual in their situation should have set aside for income in at least something lower risk
Yeah.
all times?
And you're right. I don't know that there's and you ask any advisor on our team here at WA Smith Financial, you might get a slightly different answer on this, but I like having 30 to 40% of someone's income need. So in their case, they need $3,200 a month. I'd say, hey, what's 40% of 3,200? And if we have enough, at a minimum, let's segment a portion of your portfolio to solve for that need.
Yeah.
Some people might want to see more than that.
Well, and you got Social Security and pension. So on the entire monthly income need, you're up to probably 70, 80% coming in on a pretty predictable basis.
And here's another way that you can do it too. And I've done this with people before, but the need's $8,000 a month. Let's segment the $8,000. How much of that's basic necessities of living?
Exactly.
How much of that is joy?
Yep.
Maybe they say, hey, 6,000 is what we need to pay our bills, and the 2,000, that's to do all the stuff that we think is fun. And we don't want to give that stuff up, but if we had to tighten our belt, we could.
Yeah.
Right. But we need the 6,000. So now you run the math that way. So I just think some sort of segmentation plan is a really good idea for them to look at.
Yeah. Good. Last one that I think they need to do has to happen is, at the end of the day, kind of reframe their expectations, get out of that anchoring bias, focus on forward looking now, and focus on risk. If you're in a situation where you could go super conservative, I'm not saying to go do this, but your plan works, then why take the major risk of just letting a market or an economy or who the president is or
how AI is affecting everything.
All these different things impact your future, your retirement. And so it's really just reframe those expectations, build a plan that's on sustainability, not just, hey, here's what the market has done the last 10 years and that's what's going to happen the next 10 years.
Yeah.
And just kind of crossing your fingers that happens. You'd never want to be in a situation where you're in good shape and you let a market decide that you're all of a sudden in bad shape.
Yeah. Love that.
Yeah.
And so here's the bottom line. It doesn't matter where you're at, whether you're a pre-retiree, already retired, if you're worried about the market bubble or you're not worried about market bubbling up or what the future of the market holds, how it'll affect your accounts. You owe it to yourself to get an evaluation done, a stress test. We can do this for you. If you're the type of person who needs financial guidance, wants to work with a professional team, a team of wealth managers, comprehensive planning, that is what we do at WA Smith Financial. Go to riseandretirement.com. We'll offer you a 30-minute complimentary phone appointment with one of the advisors on our team. We can start walking through your plan, determine if a stress test is warranted, and we can even go as far as to help you with that cost and risk and that stress test analysis. But go to riseandretirement.com. Limited availability for that. So check it out if you can. We'll see you next time.